This is the first part of a three-part series that we're running here in relation to US expansion. I have the pleasure of being joined by Corinne today, and I'll let Corinne do an introduction in a second. But today's session is going to be very much around scaling into the US operations, how to avoid kind of key finance and tax mistakes. We'll touch on some of the areas and lean into kind of Corinne's experience in a little bit. So we'll look at both when you're scaling into the US, optimal structures, actually when not to set up versus when to set up. We'll cover that off in a bit of detail. We'll look at some of the key considerations around, entity setup, entity structure, wider considerations once you've got a subsidiary in play. Then what we'll do is we'll flip it over into if there is a requirement to set up a topco, right? And why you might set up a topco. So what are going to be some of the key areas that you'd look at? And then again, we'll delve into some key concerns that often get raised too late in the day. And unfortunately, we see this happen too frequently. So we'll cover off some of those areas. And then the final bit will be, as everything that I always do, is covering, some of the diligence risks and concerns and considerations that we face as we go through either future fundraise or liquidity events. I'll have the chat bar open as well. I will try my absolute best to see if I can run that at the same time, but multitasking is not something that I'm great at. So just for anyone that doesn't know me, I'm James Peck. I'm the head of tax here within the tech and high growth team at Ecap Parry. We specialize in kind of VC, PE, backed scaling tech, e-commerce businesses. And my background is quite heavily focused on international growth and M&A transactions. Corinne, shall I kick over to you?
Awesome. Thank you, James. So, hi, everyone. Thanks so much for joining today. My name is Corinne. I am now the founder and CEO of a company called Ecap Financial, but I'll come on to that in a little minute. In terms of my background, I was at KPMG for about 5 years, qualified accountant in audit, and then I moved into the tech space where I've been for about 12 years now. Mainly held commercial finance director type roles, focused specifically on fundraising and M&A. Left the last company I was at in early 2023 and set up on my own. And now we have a small team and we do kind of like two core things. So one is we do financial due diligence for a number of different investors, and they're mainly like VCs, but then also high net worth individuals as well who are looking to invest in companies. So we write red flag reports for them. And then on the other side, we also do fractional CFO work for companies who are focused mainly on fundraising or M&A. So we build models, decks, data rooms, TAM, SAM, SOM calculations, like any of the collateral basically required as part of going to market. And I've known James a while now because I do seem to work with a number of companies, or have worked in a number of companies where I've had tax issues that I've had to call them up and be like, help me. And I think the US tax piece is a really big one. So after KPMG, I joined Go Cardless. They're obviously US Topco. It was Y Combinator backed. So there was a need for the US Topco. But then subsequent to that, worked at companies where they've had like a UK Topco and then US subsidiary. And I think at the time I didn't fully appreciate the kind of like core tax differences or differences in general between those kind of two sort of like core situations. And I think one thing maybe to start us with, James, is like I know personally, like working at companies or working with companies, there's a real kind of like keenness in the UK to expand as quickly as possible, particularly into the US. And the US obviously has numerous number of kind of like states that you can set up in, but also as well like different considerations, and maybe at a broader level before we go into more like commercial considerations for setting up in the US. You can maybe talk to like when actually you need to like establish some kind of subsidiary or some kind of branch or something like that in the US, at least from a tax perspective.
Yeah. Okay. So I always cover this with kind of four kind of key points when we're thinking about scaling into the US market, right? Or any market for that matter, actually. So the way I look at it is I'm going to discuss kind of two key tax areas, and then what I call like the more kind of commercial lens areas, because I think they're kind of the driving factors. And when it comes to these things as well, like just being completely transparent, and this might be strange for a tax partner to say it, quite often actually the decision needs to be a commercial-led decision, and then tax always follows afterwards, which means that I take second fiddle in terms of the advice. So that's important to take into account, and we'll come back to that in a minute as well. So when we're looking at a kind of commercial lens, I look at this both from a client perspective, but also a company-led decision, right? So let's take an example. You may have a UK standalone entity as it stands at the moment, right? We'll come on to topcos at a later stage. So when you've got a UK trading entity, let's just assume that everything sits within that single entity. So we've developed the proprietary technology within that business. We've got all staff within there. That's where our revenue streams and our cost base is, just to set the scene, right? Really importantly, we've developed the technology. That's where our IP resides. So from a company perspective, if you're thinking about scaling and growing internationally, one of the things that you may want to do is considering de-risking the wider scale, right? And what I'm talking about there is if I was going to go and scale into the US market, actually delineating between a UK and a US entity, and therefore if there was ever a lawsuit that was brought against us as a business from a US perspective, where would I rather have that lawsuit? Not that I don't want a lawsuit in the first place, but fundamentally, if I could set up some kind of sales operation and then I contracted with clients through that sales operation, there is a kind of veil of incorporation between the US entity and the UK business. I'm therefore protecting the UK business, the IP, to an extent by doing that. So first and foremost, I think that's a really it's a consideration that needs to be thought through. And again, there's going to be an inflection point with all businesses, and we're going to discuss that at some point around when is the optimal time to set up, because obviously there's going to be admin and filing and tax requirements as you scale into your US operations. So that's one of the kind of considerations that a company should start to think about. That's the company lens. The other lens is a kind of commercial lens, like a client-led lens. So actually, as you start to scale your operations into the US, one of the key considerations actually is that your client base may not want to engage with a UK business, right? They may not want to engage under UK law and specifically say, we only want to engage with you under US law through a US entity. And therefore, as a result, it may be the clients dictating that you set up a subsidiary in the US. So again, those two areas need to be thought through. The third one, I'm going to go back to tax for a minute, is actually you get to a point where you're triggering a permanent establishment, a presence nexus in the US, right? So generally speaking, when we're looking at this, how are you triggering a permanent establishment? And I can cover this in a bit more detail later on, but fundamentally, you've either got a fixed place of business, you've set up an office location, that's going to be most prevalent from a US perspective. Actually, if you're starting to kind of put major servers into the US, that may act and trigger that as well. We've seen instances of that arising in the past. Or actually, if you're starting to put more senior resource into the country, specifically in relation to sales teams. So again, these should be kind of flags that you start to consider, because once you start putting boots on the ground, especially sales and creating an agency permanent establishment risk, actually you will need to make a decision at that point in terms of what are the next steps. And again, we can cover that in a bit more detail. The final point is kind of slightly tax and it's slightly commercial, but I've kind of heard this argument so many times, which is as companies look to hire senior resource in the US, one of the predeterminations for those individuals that are looking to come on board is actually, yes, I need to understand what my base is going to be. I need to understand what my medical cover is going to be. I need to know what my wider comp and my bonuses are going to be. But again, I think with a lot of tech companies, they want to understand what a share option or stock option plan is going to look like. And again, actually, if you're even going to market to hire these individuals, quite often they'll turn around and say, we want to know what that looks like in advance, right? And actually, do you have anything set up for it? So you can put stock option plans through with EOR providers, but actually having a subsidiary and setting up some kind of sub-plan, discounted stock option plan is really powerful, especially given how competitive the recruitment space is, especially around senior people. So I always put it down to those kind of four key areas about, they're the key drivers around setting up a US entity, but there may be a whole raft of reasons why you might not choose to. So like, Corinne, is there, when we're looking at this, you may not actually want to set up a US entity, and that's fine to start with as well, isn't it?
Yeah, very much so. I'd say sometimes, again, when we focus on the fundraising side of things, people are like, "Oh, we need to have an entity in the US for US fundraising, or we need to do some kind of flip." And I know we're going to talk about that soon, James. But like, my experience with that is like, investors want to see US traction, but that
Yeah.
doesn't mean, as you say, that you need to have like boots on the ground or some kind of like subsidiary out there. Like, we worked with a company where like 20% of their revenues were coming from the US, all derived pretty much by the UK sales team. So and again, that's very appealing and attractive to a US investor. It doesn't mean you have to go and set up a subsidiary to go and take funding. Can I ask James, because I know when you say permanent establishment, is that a subsidiary or a branch? Can it be
Ah,
either, or yeah, what does that look
yeah. So we'll come back to that because there's one point that you
like?
raised I just wanted to go into. But yeah, when you've worked out around if you do have a presence in the US, then you have a decision to make. But we'll come
Okay.
back to that. No, you're absolutely right. So your example is really key, which is you don't so in order to trade in the US,
Hmm.
you don't per se need a subsidiary in order to do that, right? One of the most basic concepts of international tax is whether I am trading in a country or whether I am trading with a country, right? And just to kind of like make sure that we're all on the same page in relation to this, when I'm trading in a country, that's more in relation to I have boots on the ground, I have individuals who are actively selling to that wider market. Okay. When I'm trading with a country, that doesn't mean that I've got individuals in country. Okay. So you're using your example. If you have a UK standalone entity and you've got a UK sales team who
Yeah.
are actively engaging, or you have a website that does that, actively engaging with US customers, in theory, you have not necessarily triggered a US permanent establishment. So actually, there is no requirement for you to potentially having to go and set up that subsidiary at this time, right? One of the things that I'll make really clear is that all businesses will go through an inflection point, and this is the conversation I have more often than not, which is when have you hit that inflection point, and when does the change need to happen? And we'll cover that because it kind of starts to encompass more of the operating model, things around transfer pricing, wider considerations as you scale and grow into that US market. But it's really important to remember that if you actually don't have boots on the ground, but you have US customers, again, you don't need to necessarily go and set up an entity in order to register for federal and state tax. But can I make a big but? There is a big but. Um, there is a requirement for you to still register for sales tax in the US. So a
Yes.
UK standalone entity that is trading with the US still needs to go and make sure that it's considered its sales tax obligations and relevant filings. Okay. Now, it's a bit of a pain point, sales tax, and I'm not going to attest to being an expert in this, but the first thing that you need to do is understand whether you have any exemptions in play on a state by state basis, right? So look at the business activity, look at what you're doing and how you're trading in that country, in that state. And then from that, you then need to look at both the quantum of transactions and the volume of transactions. And frustratingly, that can differ between states. So again, that's an area that needs to be looked at. Just so we're all on the same page, this comes up quite a lot during diligence. As it stands at the moment, the IRS are still not issuing penalties and interest for late registration of sales tax because they know that quite a lot of companies are still getting up to speed in relation to relevant filings and submissions. My gut feeling on that is it won't last forever, and therefore it's not something that can be put off, forever. But if you're not making those registrations, it's probably worth having a think about.
Got
Now,
it.
I've given quite a clean answer there, which is when you do need to set up, when you don't need to set up, there's a bit of a gray area as well. Okay. So let's take our standalone business. Now, early doors, we had a very clean example. We had the UK sales team in the UK selling to the US market. The gray area is when you start to kind of like merge between the two. So what's the point when you're going to create a PE? And I think that's the question that you were asking, right? So like there can be a point where, for instance, if you are just testing the market in the US, you're sending people over to do early stage reconnaissance, understand market saturation, see if there's a kind of product fit in terms of the market. Effectively, if those individuals are not habitually negotiating, concluding, and signing contracts on behalf of the UK business, you're not creating an agency PE. And if you're not hiring an office space, you're in a bit of a grey area where you're just kind of testing the market to ensure what, if the US is going to be the market for you. By the way, this is applicable not only to the US, other markets as well. Okay. So I think there's that kind of grey area to start with. Then what we may see is individuals going up and sending junior resource over to the US, right? And again, at that point, you may want to start considering how you're going to engage with those individuals. And again, do I need a branch or a sub? Okay. A lot of people will probably set up and start to use employer of records, EORs, for those first initial hires. As a general rule of thumb, that can become quite expensive quite quickly. And also, if you're looking to hire more senior people, then you want to put those stock option plans in place as well. So,
Actually, James, just on that point, sorry, someone has asked in the chat whether if you employ US people through an EOR for boots on the ground, does that count in terms of a permanent establishment?
yes, it can do.
It can.
Right. Okay, it can do. It can
Yeah.
do. Sorry, tax answers are always kind of slightly in the grey. So EORs are brilliant because what they will do is they will basically cover all of your payroll obligation taxes in country. So think about an EOR as someone who will, it's a back-to-back contract. So you engage someone like Deal or Remote, they will then hire that relevant individual on behalf of you, right? So your payroll obligations are then covered. What it doesn't cover, an EOR will not cover this, is if that individual is in any way, shape, or form created a taxable presence for you in the US. So we just got to be mindful of that. So just in the back of your mind, I don't know who asked the question, if the EOR provider is for, I don't know, salespeople, then again, I think, yeah, you probably need to look at that and address it in a bit more detail. If you're looking at bringing senior hires across, again, you probably want to think about, is an EOR the right provider? As a rule of thumb, and it's only a rule of thumb, EOR, the benefits of an EOR are outweighed when you've got somewhere between 4 to 6 individuals. I can see lots of questions coming in on this. So what I'm going to do is I'm going to scan them while I ask Corinne a question, and then see if I can slot them in. If I don't answer them, we'll come back to them at the end, if that's all right.
Can I talk maybe about the commercial point actually while you're
Yeah,
scanning
yeah.
that? So and again, I think in the UK we're very keen to get into the US market as fast as possible. I'd say, and again, when we're thinking about fundraising, I see a lot of like financial models where people just put in US expansion. But actually, like you need to really kind of break down and think about what US expansion will look like. Like what state do you want to have individuals in? Like what state are your clients in? Like, and really kind of like flesh that out in terms of like the number of SDRs you need to hire, the number of AEs you need to hire, like whether you need customer support in the region, like really kind of like break it down into a lot more detail than just like US expansion. We're putting in a financial model for like 3 million a year. And I think one question I had, James, was just around, I know from like a US topco perspective, like Delaware is the loved state of choice. If you are, unsure in terms of like, where you want the employees to be, like they could be potentially remote versus your clients. Are there any states where you're like, yeah, that's a good one, just in terms of like having employees, or are there any where you're like, actually stay well clear?
It's broken down into two parts, that question, right? So when you're incorporating an entity, and we'll talk about the different structures that can be set up in a little bit, most people will incorporate in Delaware, right?
Yeah.
And the reason why they do this in Delaware is a number of reasons. But the key one is actually it's a legal point. So in Delaware, you're able to incorporate in Delaware, but set up your office location in any other state.
All
The
right.
reason why that's really useful is because if you want to port where the office location is,
Yeah.
it's easiest done through Delaware. So Delaware allows you to incorporate in that state, but then have, offices in New York, California, San Fran, wherever it may be, right?
Yeah.
So that's one of the key reasons why Delaware is seen. It also has lower incorporation taxes as well, which again is a small play in relation to that. I hate giving this answer. I really hate giving it. It reminds me of like someone I used to work with. The other reason why everyone uses Delaware is because everyone uses Delaware, right? So it's like it's that answer which is it's plain vanilla, it's easy, everyone understands when you've got a Delaware Inc., right? And it's a kind of bog standard answer. But if you're going through diligence at a later stage, people understand it. If it's being scrutinized by lawyers and tax advisors in the US, they understand it straight off the bat, and therefore it's a simple one to do. But you're right, it goes back to it's actually a wider question than tax, which is when you're thinking about where to set up, like what are the key drivers and what have you seen as the key areas when setting up kind of your US presence?
Yeah, I'd say where's your client base? And if you're going to be going to their offices and you're going to be seeing them in person, like go to that state. I think a lot of people pick San Fran because it's kind of like the tech hub, or even sometimes New York just because it's well known. But actually, like, where are your clients based? And I've actually seen companies set up in like Atlanta or Nashville, just because, again, there was in fairness, it was cheaper from the perspective of like hiring, but also as well that for that specific industry was where there was a strong client base. So like I'd say actually that's a really kind of core driver.
I was in Atlanta last week actually for a conference, and we covered that in quite a lot of detail, which is the mistake that everyone makes, which is if you go and set up in San Fran, you're like 8, 9 hours behind,
Yeah.
right? New York, yes, you get the time saving, but it's super expensive to do it. Atlanta has great transportation links. It's where Delta set up, it's where Coca-Cola is founded. And the
Yeah.
reason for that is because it's so easily accessible, but again, cheaper, has good resources and other areas like that. So they're kind of key considerations. So I think, yeah, a lot of people kind of go to the US with this idea that, it's going to either be a kind of East Coast, West Coast thing, right? And
Yeah.
we've not even touched on how expensive it is to go and, set up and how to kind of scale into the US market. So a lot of companies that I work with, you know, there is a bit of a rule of thumb from the VCs about how much they almost expect at times that you should spend on it in terms of your US expansion. I know there's a couple of VCs on here today, so maybe one of them will be brave enough to put their hand up and say what they expect to spend. Not gonna put hold anyone to account on that, but I've heard numbers being bandied
Yeah.
around.
Yeah, I mean, like employee costs, because it's not just base salaries are much higher. It's not just that, but also as well, particularly if it's salespeople, like with all due respect, in the UK, sometimes sales is not seen as like a proper credible profession, whereas in the US, it is a very credible profession and people are comped very well for it. And then you've got base, you've then got commissions, you've then got medical insurance, you've got pensions. You've got stock option plans, setting up new things like RSUs, for instance. Like it's a lot more expensive, and that's before you've even considered like any kind of like rent, offices, things like that. So yeah, it's not a small decision to make when you're thinking about going to the US.
Yeah. So that's the first point we raised, which is you can have a UK standalone entity, which is trading with the US
Mhm.
until you get to a certain size. That doesn't mean that you are, from a fundraise perspective, the VCs are not going to say you definitively need an entity, a subsidiary in order to do that. But also it means that you can grow and scale, at the right pace, right? As opposed to using the funding that you've got already in order to scale into that market, you can build up to critical mass and then move across at the right optimal time. And that's, I think, a really important messaging about when is the right time. And maybe I don't know if we cover that today, but when's the right time to go to the US? And I've heard both arguments, you kind of either go early, right? And you kind of create some kind of critical mass in the US, or you go to a later stage. You don't go in that soft middle because it can be quite challenging to kind of go right in the middle ground because that's when you have to spend the funds that you might not have And the other question that I'm not going to address today, but we'll pick it up on the next session that I'm doing with Barney from Clio, is actually, how do you really make an impact when you go to the US, right? Is it a founder-led proposition, or can you do it by hiring only in the US without sending over key people or the founder? But we'll address that on another occasion. Just in terms of the questions, Edward, we're going to come on to transfer pricing in a little bit. And Laura, you've asked a question about economic nexus versus PE. Think about them as the same, right? Permanent establishment, nexus, taxable presence, the terms are interchangeable. So I think that is where we get to. So, sorry, Corinne, you asked me a question a little while ago, which I deflected, and I'm now going to come back to, which is, do you set up a subsidiary? Do you set up a branch, right?
Yeah.
So I think there's a kind of decision tree that a business goes through. Do I need to set up? Should I set up? And if the decision is actually I'm triggering, back to Laura's point, economic nexus, permanent establishment, taxable presence, then actually it's more likely than not that you need to set up. Alternatively, you need to because either you want to protect the business, the IP, or your clients are asking you to go and set up a business as well. So let's make the decision that we've said, yes, we're going to go and set up some kind of entity in the US. The decision from there is, do I set up a branch or a subsidiary? Okay. Very quickly, if we think about a branch is an extension of the UK business, as opposed to a subsidiary, which is a separate legal entity. And we're going to discuss very quickly, like which different legal entities can be set up as a subsidiary. I'll give you my personal preference, and that just shows how sad I am as an individual, that I've got a personal preference of which entity I would always choose. But it's founded in kind of transaction and other kind of tax matters. But yeah, the thing that I always do is, so again, I would probably always go down the route of creating a separate legal entity. A branch would be useful because you are able to kind of utilize losses that are created. But I think that gets outweighed very quickly. And then there's also concerns around incorporating a branch at a later stage. So I kind of cut through all of that and I say, well, actually, isn't it easier if we're going to have kind of create a presence in the US, that we go straight to the jugular, right? We set up the subsidiary and that's how we run it. There's other things around the fact that it's an extension of the UK business that also may be unattractive. And also it doesn't give you that legal IP protection point either if it's a branch. So again, it may not be something that is too attractive. So once you make that decision, and more often than not, I've been doing tax for about 18 years. It's very rare that I see anyone setting up a branch in the US. We're creating a subsidiary. And I guess that then kind of leads to another question, which is, where do I set up and what legal entity do I choose? Okay. So Delaware seems to be the answer that we discussed before. And then we've got an abundance of other kind of structures that we can set up. I'm not going to go into too much detail on this because I could cover hours on it. And we're already rattling through time really quickly. So basically, when I'm looking at this, I think the options that are normally presented to you are, and again, I'm just going to be completely transparent. It's presented by a lot of lawyers, US lawyers. They really like LLCs, right? They'll always say an LLC. Mainly, when I've dug into this a little bit, because it's very easy for them to set up. They're very familiar with LLC structures in the US. They know exactly how they operate. Because you can do it very, very quickly. The alternatives, you won't choose an S Corp because that's more akin to a partnership, or you choose an Inc. So the main two options that you've got are Inc. versus LLC. If you think of an LLC more like a partnership, and a lot of US entities are set up as LLCs. That's why they're very familiar with that. My personal preference, sadly, is that you always set up your subsidiary as an Inc., right? 100% owned subsidiary, paid up, share capital of the UK business, okay? There are a couple of technical reasons why you do that. Again, putting my diligence hat on for a minute. When I'm looking at EMIs, share options, and when I'm looking at EIS, there's a criterion there that talks about qualifying subsidiaries. Okay, qualifying subsidiary is defined by looking at the subsidiaries of the group that you control more than 90% of the ordinary share capital. And ordinary share capital is really important here because actually that's how the legislation defines it. Now, an LLC has a membership agreement as opposed to ordinary share capital. And therefore, actually, there could be a theoretical risk that if you set up an LLC, that you don't meet the relevant criteria, which could taint EMI and EIS at a later stage. Can I just make this point? It's a theoretical risk. I have raised this point with council and with HMRC and never been given a sufficient answer on it. But if I looked at the letter of the law and I was being really mean on a diligence, I'd probably raise that point. But if you want to be absolutely crystal clear in terms of the approach to it, then that's the approach that I would take. Also, an Inc., we're probably more familiar with it from a UK perspective. Think of it similar and akin to like a limited company, right? So we need to think about how we're going to operate between the Inc. and the limited company, which is going to take us on to Edward's point around transfer pricing, but also kind of profit repatriation and the like. So there are different ways. An LLC also, how do the funds get dispersed from an LLC? There's more flexibility in terms of an Inc. and paying out dividends and things like that. I think that's the kind of key areas that I would look at when I'm looking at the kind of corporate structure. There's either kind of like wider considerations as well that we look at. So Corinne, have you got when we're thinking about the wider setup of the US operations, is there anything else that you've seen as a kind of key area?
I thought you're going to ask me like which subsidiary setup is my favorite. I don't know. Other considerations. Yeah, I think just again coming back to, and there was a question in the chat, it was like, if you can get clients to sign on UK contract documents and you can run everything from the UK and really scale out the US as far as you possibly can before putting anyone in that region or that geography, that would be my kind of suggestion. And I say that with a finance hat on as well, which is like it's cheaper, it's easier to do, you get the kind of like presence, they can get everything like right from the UK and then like create a diversified workforce, because as soon as you put anyone in other territories, whether it's the US or otherwise, you are creating like time zone differences, you create cultural differences, you create like all kinds of differences that not are necessarily like tax per se, but are just kind of more like operational corporate governance, like those kind of things, which it may not even be expensive from like a financial perspective, but like are a time expense for the business overall. So yeah, I think those are the kind of main things. I think a lot of people are itching to get onto transfer pricing. And I know, James, it was one of the things that I called you up about like earlier this year when I was like, I've got this thing happening from a transfer pricing perspective. Can we chat about it? Maybe we segue into that.
Yeah, let's go into that.
Yeah.
Sorry, I know I'm a pain. Before we talk about transfer pricing, there's always
Yeah.
something else that I always cover first, which is it's a concept called tax residency, right?
Yeah.
And in concept, it's really simple, but getting your residency right will determine if your transfer pricing is right. So I'm going to take 2 minutes on residency. Now, in the UK, we have this concept about where an entity is primarily taxed. Okay. Now, that's not just based on incorporation, but something that we refer to as central management and control. Okay. The US has a slightly different view on primary taxing place, and that's predicated by where the company is incorporated. Okay. So let me give you a quick example. I have a UK topco, I have a US subsidiary, Delaware Inc., by the way, 100% owned. And I only have single standalone board meetings in the UK. There is an issue with that, right? So if I'm the nasty diligencer, which I can be, and I'm starting to look at the US entity, which is now a sales office, and I sit in a position, I say, well, it might look like a really kind of very plain vanilla question during diligence. And I'm like, oh, tell me about the constitution of the board meeting or meetings. And you turn around to me and said, oh, I've only got a UK standalone board meeting. Little red flag gets raised at this point, right? The little red flag is as follows, that if I only have a UK board meeting, that means that from a UK perspective, the US isn't centrally managed and controlled out of the US. So the question I'm then asking is, well, where's the primary taxing rights of that entity? Unfortunately, I have to look at the double taxation treaty, and the US-UK double taxation treaty doesn't give me a great answer in terms of like a tiebreaker in determining where the primary taxing rights is. Annoyingly, you have to go through this process called mutual agreed procedures, MAPS, which is basically where you get the IRS and HMRC in the same room, and you then have to argue the difference. You want to avoid that at all possible costs, right? So as a key takeaway, one of the key things to do when you're setting up a US entity is to think about the constitution of a US board delineated from the UK board. Therefore, when someone asks you the question, it's most likely to come up during diligence. I've never really seen it raised by the IRS or HMRC, but I do see it raised on every diligence that I do, or any of my clients are diligenced. I can very clearly go, the US has its own separate and distinct board meeting, as does the UK, right? And the constitution of those can be different and distinct, and then the aspects discussed can be different as well. But it's important that you do that kind of almost from the get-go. I'm supporting a business at the moment that didn't set that up because their previous advisors didn't think it was important, and actually set up quite a few entities in a way that was kind of dual tax resident, and we're now unwinding some of that, which is very painful and very expensive. And just to add to that, the MAPS process is super expensive as well, because let me just give you the very high level. If you've got to until you determine who has primary taxing rights, okay, and it's more likely than not that you're going to be profit making in the US, because we're going to come on to transfer pricing in a moment, and I'll explain why that's going to be the case, then actually you may have to pay taxes in the US and the UK at the same time for the US entity, right? Until you can define who has primary taxing rights. If that is the case, you do not get a credit offset between the two countries, and therefore you have to pay both sets of tax over, right? And that's quite painful. The annoyance comes when you need to then get the IRS and HMRC in the same room to determine who has primary taxing rights, and neither of them wants to give up their taxing rights. So trust me, this takes ages to resolve, and it's hard to get both parties in the room. Like, I've had instances where this has gone on 2, 3, 4 years because it's not through lack of trying, but it's not in the IRS or HMRC's best interest in order to get into those rooms, because the minute they make a determination, the other party then loses out. We're going to move on because otherwise I'll talk about this too much. Right, transfer pricing. Oh gosh, where do I start on transfer pricing? Okay. When you set up a subsidiary of the UK business, yes, you will need to think about within the first 12 months. So it doesn't need to be an immediate thing to do, but within the first 12 months, you need to think about what the operating model for the US entity is going to look like, and therefore what the transfer pricing methodology will look like. There are going to be different approaches depending on how the US operates, but it will be important to start to think about transfer pricing from the first year, okay? So when I'm advising clients about setting up their operations, I say, look, go into the US market, go and set up the entity, go and hire the relevant people, and then before you need to make any relevant filings for the first year, you probably want to think about how the interaction between the UK and the US entity. The reason why is, unfortunately, the US doesn't have a de minimis limit in terms of implementing transfer pricing. The UK does. So we have an SME exemption at the moment, right? So there is no actual requirement for SMEs who fall within the threshold to register to actually adhere to any transfer pricing, but the US don't have that. So you do need to think about it. The other reason is, again, it's more of a commercial reason, which is if you want to set up your transfer pricing and understand your intercompany right from the get-go, it gives you better certainty from a management accounts perspective, a better stats position at the year end. It also means that you forethought if you're raising funding in the future. It's what a diligencer would look to see at, future investor, etc. So very high level, when you're looking at what you need to work out what your operating model is to determine what the pricing structure is for transfer pricing, okay? So as a rule of thumb, we can run through these very, very quickly. If you've got very junior salespeople that are just teeing up meetings and kicking them back to the UK, actually, you may end up in some kind of cost plus methodology to start with. Okay, and that probably be acceptable for a period of time. It won't last forever. And the reason why it changes will be as you start to bring in more senior people that are looking to engage directly with customers from a US perspective, they're going to become more reliant on the UK business providing an abundance of services to them, a bundle of services, right? So if the UK business owns the IP, and I think someone was asking this question in the chat bar around if you've got a UK business that if you've got a UK business that owns the IP and you're starting to use that IP to sell into the US market, what do you need to think about from a transfer pricing perspective? It will depend on how entrepreneurial the US salespeople are, how entrepreneurial the US entity is going to be, will then predicate actually the model that you adopt, right? But also the goods that you're selling or the product that you're selling as well. So again, it's not a kind of like one size fits all, but there is a general rule of thumb that as you start to kind of put more senior resource into the US market, you may therefore, it may start to become more entrepreneurial, right? Therefore, as a result, you would adhere to a policy that's referred to as kind of a limited risk distribution model. Limited risks being the key here because you're not fully entrepreneurial as a US entity. You are still heavily reliant on the UK business. And therefore, what you would have is a kind of composite charge that would come across from the UK. And that composite charge would encapsulate a royalty charge, some interest based on how you're funding the US operations, and then kind of management charges as well. Okay. Now you'd bundle them together to start with, and then you'd come out with a kind of small kind of profit margin as a result of that. And that would be what the IRS would expect. It's what an auditor would expect, and it's what a diligencer would expect. So again, you're covering base on that ground. Interestingly, the way I rank those is top priority is the diligencer. I'm assuming that everyone or most people on the call today are, tech CFOs, tech FDs. Your diligencer is always the person that should concern you the most, given the fact you're going to fundraise or come to a liquidity event. Beneath that, I put the auditor, and weirdly, beneath that, I put the IRS or HMRC. Okay, they're at the bottom of the ranks, and the reason for that is because the IRS or HMRC may well inquire into your business, right? And there is a chance they're going to look at the business in a bit of scrutiny. Your auditor should be looking at the business in a bit more detail as you get to those audit thresholds. But I tell you what, I think everyone on this call today is going to be faced at some point by a nasty diligencer who's going to probe the question and do what I do, which is try to find angles to raise red flags, indemnities, warranties, price or value chips, right? That's what partly my job is. So that's why I put them at the top of the pile. So just to kind of go over that. So when we first scale, we may have a kind of cost plus that you will then get into an inflection point. You will then grow, you will scale the operations. You will then need to kind of adopt what we refer to as a kind of limited risk distribution model. And then as the business gets more entrepreneurial, you may well then become a fully fledged distribution model. Let me just reflect on that for a minute. With the limited risk, it is very, it is expected that a very small profit margin, somewhere between 3 and 5%, is generally adhered to. When you're fully entrepreneurial, then actually you can be in a position where you can actually generate losses. Right. So again, it's one of those things where you'll need to sit down with a transfer pricing advisor, work out exactly who you've got and the direction of travel as well in terms of your transfer pricing, and then you adhere to it. With a fully fledged model, you don't have a composite service. You start to break them down. So what is the level of interest that you're charging? What royalty should be charged? What management charges should go across as well? So looking at all of those different areas. I didn't realize how much time we'd already used up. So if anyone wants to talk about transfer pricing in a little bit more detail, I'm just going to say, ping me a note afterwards and we can talk about the structure that you have and take it from there. But yes, I think transfer pricing is very important as you scale and grow your operations. It gives you the base. It's transfer pricing is not so much tax. It's more about kind of economic analysis. Right? Working out where profit should sit. And just be aware as well, I've seen instances where you can end up with disproportionate profitability because you start to pump revenues through the US entity, but you've got a really skinny cost base. So again, you want to just be careful about making sure that you're ensuring that the right cost base is sitting there and making sure that there is kind of a clear plan of attack when it comes to both the US and the UK. You may not need to console for accounts purposes, but actually you should be looking at on a worldwide basis. So I think they're the kind of key areas when it comes to kind of transfer pricing, considering the operating model. Can I just raise another red flag as well? and then we'll move on to the top co considerations, which we're not leaving ourselves huge amounts of time for. Sorry, I talk too much. Which is, can everyone on the call today just have a moment where like this is something that needs to be discussed with a tax advisor, right? We've got a UK standalone entity. We then grow and scale. We set up a US subsidiary. We start to engage through through the US entity. No issue at all. We've covered all the kind of key areas to look at: federal, state, sales tax filings. One of the things that is really that everyone needs to take into account is you will have had US customers to start with through the existing UK business. Okay. Don't just lift and shift your contracts from the UK standalone entity into the US business without talking to a tax advisor. A contract is a right to future revenues. It's an intangible fixed asset. And if you lift and shift that asset from the UK into the US tax net without considering the wider tax implications, you end up with what's referred to as an exit charge or a dry tax charge. There are ways of doing it. I'm not going to cover it today because it takes a little bit of time to explain, but don't just move into a position where you move contracts between the UK and US without wider consideration, because it can get quite nasty. Right. If there's any other questions around subsidiaries, US subsidiaries, just let me know. Happy to cover it off, but I think we should move into kind of top codes. Okay. So as you said before, we've got, it's quite often that you can have a UK trading entity, a US subsidiary as well, right? And then there may be a number of reasons why you may then think about inserting a top co, and it's often referred to as a US flip, right? I don't like the word, like the concept flip doesn't work, because flip suggests you're taking your US subsidiary, which is your trading co, and flipping it up above the UK business. I always refer to it as like an insertion, because you're inserting a US top co above it. But Corinne, from your experience, like when have you, what's the reason why companies are being asked to insert a US top co?
So we've only worked with a couple of companies where Y Combinator has basically said, hey, you need a US topco, and that's, how you end up on our not how you end up on our accelerator program, but like, to actually go through the application, you need to have that US topco. So I actually think for me, I've seen that's the driving reason for any kind of entity basically being like, oh, okay, yeah, we'll put in a US topco. I think, like I've said before, some people think they need it for fundraising purposes. I vehemently disagree with that. I think there's a lot of like big US outfits who know how to fund a UK topco. And I think, uh, I think anything particularly like Series B onwards, like you're talking about your really big kind of VCs, and they will happily fund a UK topco. So, I mean, that's been my only experience, is basically Y Combinator has caused that.
Yeah, I've seen it with YC do it quite often. There's a number of other US VCs that require it. So let's just reflect on that for a moment. So in order to go and initially raise in the US, you do not need to create a US topco, right? So don't go and create a US topco, because that creates additional complexity. And first and foremost, the US investor may not need it as a requirement, okay? There's quite a lot of, there's a lot of US investors that will come in and directly invest into the UK topco. So that's not a kind of key area. And also, you may not raise in the US. Let's just be really honest here. Like, you may choose to go and raise in the US, and you may go and find funding in the UK, across Europe. And therefore, you're then stuck with this kind of corporate structure that you don't necessarily want. So yeah, I would say the point when you should do the US flip insertion is when it is a prerequisite from the VC that's coming in, and make sure that actually it makes sense for you at the right time. So it may not, if you've got multiple offers at a Series A, you may choose not to invest through that US investor, right? As you scale further, looking at the different options. Now, a US topco, just to be completely clear, is often what I'd refer to as a passive holding company. Okay, it does nothing other than holds the funds and then disperses the funds within the wider group. It is not, or it should not be seen as your active trader, in my opinion. You should have a separate operation that you trade out of the US. So it is quite normal for you to then create a US topco have a UK trading subsidiary and a US trading subsidiary underneath it, right? And again, that's a kind of well-trodden path. The process of a US flip is quite complex at times. It depends also, like if you have EMI or EIS in play as well, making sure that you kind of jump through the hoops in order to satisfy those tests is going to be important. EIS absolutely key. So if you've raised investment in the past, inserting US topco, you do need to take some consideration in relation to that. We know that the rules around EIS are becoming more challenging. And one of the things that you will need to do is create a UK permanent establishment of the US entity in order to maintain and satisfy the EIS or SEIS criteria that you've got. Otherwise, you break that, and that can be a disqualifying event from an EIS perspective. EMI is slightly simpler because you can port your EMI options up to the topco, and therefore you can still have EMI in play. But again, you need to think strategically around how you set the entity up. And again, you do need to take advice in relation to that, because you don't want to end up in a position where you've got your EMI, your EIS in a subsidiary. Unfortunately, one of the criteria for both of those is that there's an independence criteria that says actually it has to be the topco that has issued the EIS and the EMI option. So again, prevalent for tech companies, this is an area we really need to think through. Um,
Can I just quickly, because there's a couple of things in the chat. So someone basically said, hey, their US investor basically mandated that they do a US topco. So that kind of chimes in with your point there, James. There's another person said that does having a US topco result in a negative outcome for founders from a future exit perspective, putting to one side any valuation related differential and exit? And I don't know about you, James, because I sometimes work with CEOs where I'm like, hey, you might want to think about putting your shares in some kind of trust so that you're kind of sheltered in some way from certain tax obligations. But like, does that work for, UK topco and US topco?
At the end of the day, so from a founder shareholder perspective, you're considering what the ramifications are when you come to sell those shares, right? So it's not going to have a negative impact on you, assuming that you remain. Well, I'm going to sneeze. Sorry. Sorry, hay fever. Assuming that you remain UK tax resident, okay? So it shouldn't have a negative impact. If you remain UK tax resident, then obviously you're thinking about what that means from a capital gains tax perspective in the UK. I'm not going to open the discussion around what's happening with the current government, but capital gains tax rates are increasing. We've obviously got business asset disposal relief or entrepreneurs relief, which has, again, that's increased. It was 10%, now it's now 14% on the first million. My gut feel on CGT is it was at 20%. It's now gone to 24% effectively from April. My gut feeling is that that is also going to increase. I'm having quite a lot of conversations around how founders, shareholders can mitigate future taxes on liquidity events, secondary transactions, and the like. But we get in that hole, we're going to be another like half an hour discussing those areas. So we'll save that for another day. But having a US topco shouldn't be disadvantageous in terms of the setup in any way, shape, or form.
James, I know we haven't got a huge amount of time. Can we touch on one area which I think actually triggered this whole conversation between us? Because like we obviously do financial due diligence as well, more from the financial side rather than from the tax side. And one thing we see a lot of, and I personally just hate it, even as an accountant, is intercompany loans. And particularly when you're trying to move money from Topco into sub, like in my experience, I've, looked to move it and like basically issue shares in sub and crystallize something kind of like in a Topco perspective. Like, do you have any tax thoughts around that?
Yeah, I really do. Okay, so painting the picture again, we've now got a US topco, we've got a UK trading subsidiary, we're taking on investment from YC or some kind of US investor. And so what we're doing is the funds will be dispersed directly into US topco. And then what normally happens is the funds then flow down into the trading sub, which is basically where the activity of the group is being undertaken by intercompany loan. Okay, so what then happens is there's an intercompany between the US topco and UK trading subsidiary. So US is debtor, UK is creditor. And therefore, what then happens is we start to then think about so what we start thinking about is application and transfer pricing or an arm's length charge in relation to that. Okay. And therefore, what have I got? I've got an interest payable position in the UK and an interest receivable position in the US, right? UK has borrowed the money, is paying interest back up to the US. Yes, there's a withholding tax consideration, but we'll park that for the time being because that's not the main issue here. So, what I've seen on a number of companies is that builds up over a period of time. Okay. Now, it becomes an issue because if it doesn't get caught early, you then end up with a very large balance owing between the US and the UK because they disperse the funds down. And therefore, you can be in a position where the UK is then paying substantial amounts of interest or accruing interest to the US entity. Why is that an issue? As I said before, most of the US topco is kind of a passive holding company. It is only holding the investment, it's receiving the funding, it's pushing it down directly to the UK business. Okay. And therefore, what can happen quite quickly is the US entity is then in receipt of interest receivable, a credit to the P&L. But as we said, it's got very small cost base. And it's quite hard for us, even with transfer pricing, to actually push any cost base up into the US entity. So you can end up with a position where you have disproportionate levels of profitability arising pretty quickly because I've got interest receivable in the US, minimal or skinny cost base in the US, and therefore I end up with a tax base in the UK, in the US entity that I have to pay tax on. And that's arisen because I'm using the funds in order to develop the UK business. The UK business, in this instance, is where actually I'm hiring the relevant people, I'm developing the technology. That's what I'm going to be doing. So I might be in a position, unless I kind of address this early doors, where my UK company is going to be quite heavily loss making. Okay. And I'm going to continue to make losses and have historical losses. I will be able to claim R&D tax credits, although they're reducing in the UK. And then I'm in a position where, because of this kind of growing intercompany position, I then end up paying cash tax in the US. So yeah, this is something that you raised with me, and I've seen it on multiple occasions, and it can be overlooked, but it needs to be addressed early doors. When I'm advising on this, it's quite easy how to approach it. So we've discussed how intercompany can play in on this instance. But actually, there may be other options. So do I put the funding into the UK trading subsidiary through some kind of capital injection via equity? And that then removes the requirement to impute any kind of transfer pricing. Again, if anyone's dealing specifically with this area, do let me know. We managed to run over time. Like, there was so much more that we were going to cover on this today. So
yes, yeah.
thank you, Corinne. Thank you so much for joining me today to kind of run through those areas. What I'll do is, if I've not come back on any of the specific questions that have been addressed, I'll do a kind of email follow-up in relation to those. But if anyone wants to have a kind of conversation to talk about any of the key areas that we discussed today, if there's any kind of concerns, then just drop me a line, and then we can take it from there. Thank you so much, Corinne. Thank you so much for joining us today.
Thank you. Thanks everyone for joining as well. Cheers.
Cheers. Bye now.
Bye.